Hello, everyone. In the ruthless, unforgiving world of finance, one name resonates with undeniable prestige, that of Warren Buffett. This unassuming, self-made man, with his clear-cut wisdom and modest lifestyle, is none other than one of history's most successful investors, a shining figure who defied the whirlwinds of time and the caprices of the markets to amass staggering wealth. In the gilded corridors of Wall Street, Buffett is a guru, a living legend whose every word is dissected, analyzed, and interpreted by investors worldwide. But who is Warren Buffett really? How did this son of a stockbroker become one of the world's wealthiest individuals? And more importantly, what insights does this oracle of investment have to offer us? How could his strategies and philosophy illuminate our pursuit of financial independence and wealth creation? Through this journey into the life and achievements of Warren Buffett, we will attempt to answer these questions and dissect the fundamental principles that have shaped his extraordinary success. Exploring Warren Buffett's life is embarking on a fascinating journey that overlays the rhythmic movements of the 20th century economy. Picture a young boy, born in 1930, in the depths of the Great Depression. This boy is Warren, growing not in the shadow, but under the illuminating influence of his father, Howard Buffett, a stockbroker who paints the vibrant canvas of the financial world for him. The conversations around the family table then instill an early fascination for numbers, investments, and the enigma of wealth creation. Indeed, Warren Buffett does not simply observe the financial universe, he dives headfirst into it. At the tender age of 11, he makes his initial steps as an investor by purchasing 6 shares of Citi's Service Preferred at $38 each. However, his induction into the investment world is not without its challenges. After watching the stock price drop, he remains stoic, refusing to give in to panic, choosing instead to wait. His patience is rewarded when the shares rebound to $40. That's when he makes his first significant investment decision and sells his shares. Yet, the plot thickens as, following Warren's sale, the same shares take a vertiginous ascent, climbing to $200 in just a few weeks. This is a revelation for the young Buffett, who watches a golden opportunity for dazzling profits slip through his fingers. He takes away a valuable lesson, complementary to the first. While patience is an undeniable asset, an early exit from a fruitful investment can also represent a significant opportunity loss. Far from discouraging him, this experience provides a more nuanced perspective on the investment world, underscoring the importance of patience, but also the necessity for precise timing and keen intuition. These early lessons learned, combined with a sharp flair for numbers, carve out an unwavering will in him. This confidence shines through brilliantly when at just 13 years old, a fierce determination already sparkles in his eyes. He then makes a bold declaration to a family friend. Either he would be a millionaire before the age of 30, or, in a sign of despair, he would jump from the tallest building in Omaha. But Warren is not content to merely dream of wealth, he gets to work. Thus, his first job is far from ordinary for a boy his age. Instead of playing baseball or riding a bicycle, he spends his days writing stock quotations on the blackboard in his father's brokerage firm. Simultaneously, he also embarks on a more traditional job as a paperboy. Even here, his acute understanding of business shines through. At 13, he fills out his first tax return, and with foresight beyond his years, he deducts his bicycle, his means of transport for his paper route, as a business expense, for a total of $35. However, Warren does not stop there. Indeed, at the ripe age of 14, he continues to demonstrate his extraordinary financial wisdom. Rather than spending his savings on frivolities, he opts for an unexpected investment: $1,200 in 40 acres of farmland, which he rents out to farmers. It's as if, in his youth, the game of Monopoly was turning into reality. By the age of 17, Warren's entrepreneurial potential blossoms further. Together with a friend, he unearths a gem, an old pinball machine that they purchase for a paltry sum of $25. The duo quickly understands the potential and positions the machine in a local barbershop. The success is such that 3 more pinball machines join it, strategically distributed throughout the city. What started as a simple initiative becomes a thriving business, sold for $1,200 to a war veteran. In the meantime, the shadow of parental expectations looms. His father, a respected man in the finance world, urges him to pursue university studies. Thus, despite his reservations, Warren finds himself in the prestigious halls of the Wharton School of Finance and Commerce, in Pennsylvania. As he comes of age, Warren enters a phase of intense questioning. He struggles to find his place at Wharton, often considering himself more educated than his own professors. However, on the cusp of his 20th year, a new opportunity arises, offering a change of scenery and perspective. He trades Wharton for the University of Nebraska. A year later, driven by a desire for deeper learning, he decides to cross the thresholds of the prestigious Columbia Business School. It is here that he meets Benjamin Graham, the author of The Intelligent Investor. Graham, like a lighthouse in the night, becomes his guide and imparts to him the art of investment centered on the intrinsic value of a company. This investment philosophy will leave an indelible mark on his entire career. After graduation, he works for a few years for Benjamin Graham before launching his own investment fund, Buffett Partnership Limited, in Omaha in 1956. The success is immediate, as his value investment strategy bears fruit. Yet, the initial financing is surprising. 7 family members and a few friends put up $105,000, while Warren himself only invests $100. But it is not until 1965 that Buffett makes one of his master strokes, the purchase of Berkshire Hathaway, a struggling textile company. For Buffett, it is not a gamble, but a rational calculation based on the company's value. As the years pass and Warren Buffett, through his judicious choices and long-term investment philosophy, turns Berkshire Hathaway into a veritable wealth-generating machine. From insurance companies to consumer goods companies, he invests in a diversified portfolio of companies, always guided by his cardinal principle: buy quality businesses at reasonable prices. Buffett will eventually reach billionaire status in the 90s, marking his ascent among the global financial elite. His patient and thoughtful approach, contrasting with the often irrational frenzy of Wall Street, has allowed him to become one of the richest men on the planet. The impressive journey of Warren Buffett is, however, far more than a simple tale of financial success. It's a map of investment principles, a testament to the power of patience and perseverance. For those seeking to weave the golden thread of long-term wealth, the Oracle of Omaha leaves us a priceless legacy, a series of wise advice, carved from his experience and far-sighted vision of financial intricacies. It is time to reveal the precious lessons that Warren Buffett has generously shared to guide aspiring investors on the path to prosperity. Here are the 15 tips from Warren Buffett on becoming wealthy. 1. Invest in what you understand. Warren Buffett is known for avoiding investments in areas he doesn't understand perfectly. For him, understanding a business is essential for assessing its long-term potential. It also allows minimizing risk and making informed investment decisions. 2. Patience is a virtue. Warren Buffett is the embodiment of a patient investor. He has proven time and time again that patience can generate significant returns. He often waits for the market to undervalue a company before making a purchase, and once he invests, he's prepared to wait years, even decades, for his investments to bear fruit. 3. Buy stocks as if you were buying the entire company. When he considers buying shares, Buffett evaluates them as if he were buying the entire company. This approach allows him to focus on the company's financial health and long-term growth potential, rather than the short-term fluctuations in the share price. 4. Be frugal. Despite his wealth, Warren Buffett is famous for his frugal lifestyle. He lives in the same house he bought in 1958 and prefers simple meals to luxurious dinners. He emphasizes the importance of saving and investing by living below his means. 5. Diversify, but not too much. While Buffett recognizes the importance of diversification to reduce risk, he warns against excessive diversification. He prefers to focus on a smaller number of investments he understands well and has great confidence in. 6. Quality before price. For Buffett, the quality of a company is more important than the price of its shares. He would rather pay a fair price for an outstanding company than get a discount on a lesser quality company. 7. Don't try to predict the market. Buffett has always insisted that it's impossible to predict short-term market movements. Thus, rather than trying to guess fleeting trends, he advises focusing on solid, sustainable investments. 8. Look for companies with a competitive advantage. Buffett likes companies that have what he calls an economic moat, a kind of protective barrier that shields them from competition. This could be a strong brand, proprietary technology, or a unique distribution network. 9. Reinvest your earnings. Instead of spending his profits, Buffett prefers to reinvest them to generate even higher returns. This is called the power of compound interest. 10. Don't follow the crowd. Buffett has always advocated independent thinking when it comes to investing. He recommends ignoring the noise of the market and making investment decisions based on a rational analysis of the facts. 11. Be fearful when others are greedy and be greedy when others are fearful. This famous quote from Buffett summarizes his contrarian philosophy. He advises buying when others are panicked and selling when others are euphoric. 12. Never lose money. For Buffett, the number one rule in investing is to never lose money. And rule number 2 is to never forget rule number 1. This approach underscores his aversion to risk and his constant attention to capital protection. 13. Read a lot. Buffett spends a large part of his day reading annual reports, newspapers, books. He says this helps him stay informed and make better investment decisions. 14. Focus on return on investment, not on earnings. Buffett evaluates his investments based on their return rather than the absolute amount of earnings. This helps him stay focused on the intrinsic value of the company rather than the share price. 15. Don't let emotions guide your decisions. For Buffett, investing is a matter of discipline and rationality, not emotion. He warns against getting carried away by fear or euphoria, which can lead to impulsive decisions. Instead, he advocates rigorous analysis and balanced judgment to navigate the highs and lows of the market. Thus, in traversing the winding landscapes of Warren Buffett's history, we have not only explored the epic of a man who knew how to turn a small purse into a financial empire, but we have also discovered a set of timeless principles that guided every step of his journey. These principles, forged by experiences of dazzling successes and educational failures, remain as beacons for anyone seeking to navigate the tumultuous waters of investment and wealth creation. However, it should be remembered that Warren Buffett's lessons are not just strategies for accumulating material wealth. They are also an invitation to adopt a broader vision of success, one that values integrity, patience, lifelong learning, and a thoughtful and disciplined approach to decision-making. By following these tips, not only can we hope to build our own financial treasure, but also, and perhaps more preciously, chart a life course that is rich in wisdom and personal fulfillment. And who knows? Perhaps, like Warren Buffett, the young boy from the Omaha of the 1930s who dreamed big, each of us has within him the potential to turn his own dreams into reality, one wise investment at a time.